Okay, we're going to start over here a little because I screwed up on the PowerPoint right away. So in this chapter, we're going to talk about purchasing a company where we don't have a true 100% ownership in the company. You don't have to have 100% ownership to own a company. Generally, the parent will own a certain percent of the company. That makes it a controlling interest, but you'll have an NCI or non-controlling interests or shareholders that own a piece of the company. So what we're trying to look at is to determine how we combine the financial statements and show a consolidated financial statement even though we don't own 100% of it. So there's this non-controlling interest in this equation that we need to somehow account for, and how do we show it on the financial statements. So when we deal with an acquisition where it's not 100% ownership and we need to consolidate these financial statements, we're going to look at an example. So in this example, Parker wants to buy 90% of Strong. Now, what's happening here is Strong stock is trading for $60 a share. We know that's going to be the fair value of the company. But because Parker really wants 90% of it, not everyone's going to sell their stock to him, especially people who are against Strong wanting to buy it. So in order for Strong to get that controlling interest, he's going to have to pay more than what the going rates are. Now we have to do everything as though it's at 100%, but then we need to allocate our portions to the controlling interest and the non-controlling interest. So clearly Parker wants it. Instead of paying the $60 a share, which is the fair value, they're going to pay $70 a share. So they're going to buy 90% of the company by paying $70 a share, which is going way over the fair value of the assets. So what we'll do, if they purchase 9,000 shares, because outstanding are 10,000 shares. If they purchase 9,000 shares, they're going to be buying their portion, the 90%, for $630,000. Now, we are going to assume, because it's telling us the stock is going for $60 a share. That's the fair value of the company. So we're paying more than that. So we need to figure out how much in excess of the fair value of the assets is going to be attributable to goodwill. So if we take what we purchased it for, $630, and then we take 90%, which is the amount we're buying, 90% of the business. The fair value of the assets are $600,000 for 100%. But 90% of these assets are going to be ours. So we're purchasing 90% of the company. So what basically happens is 90% of the assets of the company, or our $540,000 here, is really the portion of the fair value of the assets we're buying. But we're paying $630,000 for a company where our portion of those assets at fair value is $540,000. So the key here is, in the past we've been used to buying the whole thing. What we're doing a little different here is we need to take into account the big picture, but as it relates to the fair value of those assets, we're only going to show our portion of it to determine how much is excess that goes to goodwill. You following me? So in this scenario, the goodwill is going to be the difference between what the fair value is of the assets versus the acquisition fair value. We see that $90,000 is above and beyond what the fair value of the assets are. So we're going to split the controlling interest from the non-controlling interest. And we're going to show the fair value of the assets we purchased as of the date of the acquisition, 90% of the $600,000, we're $540,000. We're going to allocate that difference to goodwill. If you look at the non-controlling portion, the fair value is still what the stock is going for. It's still going for $60 a share. And the fair value is going to be $60,000. So they don't have any goodwill on their side of the equation here. The controlling interest has the goodwill attached to it. So if the shares were trading for $70 a share, that would be the fair value. But since they're not actively trading for $70 a share, if the shares were not actively traded, the $70 share consideration transferred by Parker would be considered the best fair value. And the fair value of the non-controlling interest would be estimated at $70. So right now, this is sitting on the market. We bought it for $70 a share because we wanted controlling interest. But the others are still just going for $60 a share. If this was a company that wasn't actively trading on the stock market, why would we buy the company for more than what the fair value is? So if we can't really determine the fair value, we'll assume it's what someone's willing to pay for. So in the case of we don't know, because it's not actively trading, if that is the case, then we would assume the fair value of the minority interest would be $70 or $70 a share. Okay? This is assuming it's not actively trading on the market. So in this scenario, if we are giving consideration of $630, the fair value, if it's not trading on the market, we're going to assume is the same amount of what we're paying for it, or $700,000. In this case then, because the assets have a fair value of $600,000, if this would be the case, then we would show $10,000 of goodwill for the non-controlling interest and $90,000 of goodwill for the controlling interest. So if we have the information and we know clearly we paid a premium, then we're the only ones that are getting the goodwill. But in the case where there's a leftover minority interest and we really can't accurately determine a market price, we would take the market price we buy it for. Does that make sense? Kind of. Okay, so now we're going to look at how do we handle consolidating these financial statements, and then from there, how do we handle showing this non-controlling interest that is sitting, that's a part of this company. So basically here, the subsidiary's net income, we own 90% of it, but the subsidiary's net income will have to include excess acquisition date amortizations. Remember, what extra we pay, we have to amortize it. In this case, we've got goodwill, and that can't be amortized. That must be allocated to the owners. Assume that the relative ownership percentages of the parent and non-controlling interest are going to represent a basis for attributing all elements, including the excess amortizations. So, in the case of, we're saying $70,000 is the non-controlling ownership interest, and ours is at the 90% controlling. Let's assume Strong has revenues of $280. This is the subsidiary. They have revenues of $280, expenses of $200. So we've got net income here of $80. Now let's assume we've got some amortization we need to take care of because we purchased it and had to allocate the fair values. So our excess amortization of $30 nets us with a net income of $50,000. The non-controlling interest, because we own 90, the non-controlling interest of the net income is $5,000. So when Strong earns $80 in this first year, We've got to take into account our annual excess amortizations, and then based on that determine the percent of non-controlling interest and allocate that income to the other shareholders. So when we go and consolidate these statements, we're going to kind of keep it the same, but we've got to do something to show that non-controlling interest in the financial statements. So in this situation, the items that we're going to have to adjust relate to the non-controlling interest that was in that subsidiary at the beginning of the year. What portion of the subsidiary non-controlling net income is the subsidiaries? We need to also look at dividends. And then the non-controlling interest at the end of the year. So those are the pieces we need to do in the worksheet so we can accurately create an appropriate consolidated worksheet, financial statement. So this is in your book, and we might take some time to go back and forth because it explains a lot more in the book than it does here in the slides. Real quick, I'm just going to pull up the book. Okay, and I think it's about 170.
It's 156.
Thank you. Okay, so as we go back here, we're going to look at King and Pawn. King acquires 80% of Pawn's 100,000 outstanding voting shares on January 1st for $9.75 a share. So they're buying 80,000 shares at $9.75 a share. Their consideration for that 80% is $780,000. Now the shares are trading at $9.75. Okay, so we're not really buying this for a premium. We're just buying it for what is the going rate of the share price. The total fair value of Pawn to be used initially in the consolidation process is the $780,000 of consideration given. And then we'll look at the 20,000 additional shares at $9.75 a share. And we'll come up with that figure of the non-controlling interest, which means the total fair value of the company is $975,000. So basically, we're not paying a premium for this stock. We're just buying it at the market rate. So we're going to assume that's the fair value. Now, let's look at, in this page, the fair value is going to be what we purchased it for plus the stock price of the remaining 20%. That gives us a fair value of the whole company of $975,000. The book value on the books shows $740,000. So we've got some excess amortization going on here. The fair value in excess of the book value is $235,000. Now they tell us what some changes are. Out of that $235,000 difference, they show we need to allocate $60,000 for trademarks, $120,000 for patented technology, minus $10,000 in equipment. So basically the fair value is $10,000 less than the book value. And then 40,000 we have to add to our long-term